Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, we have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are back for our latest Ask an Advisor, and we are taking on the personas of Mr. Equity and Mrs. Mate to answer some of the most common questions we get from the Equity Mates community. We're going to be covering debt recycling. We're going to be covering using your offset accounts. We're going to be covering should you invest inside of super or outside of super. It's going to be a jam-packed episode today.
Yes, and to chat through it, as always, we're joined by Pargiter-Green. Dylan, how are you?
Boys, I'm well.
That's
Bryce
good.
has only just missed my last name this time.
I thought so. Anyway,
I'm going to change it. I'm going to change it. I'm dead set. Yeah.
Well, you know, we've got plenty more episodes to come, so he'll get it right eventually. But Dylan, you're just back from the States. You've been to Harvard, you've been to MIT, all so you can better answer questions from the Equity Mates community. We love to...
That's right. I spent all of about a day and a bit at those universities, not doing anything specifically financial planning related, but meeting a lot of really cool, new projects that are coming out of there and understanding how the investment into those projects works. So that was pretty exciting.
Awesome.
Yeah.
Well, a reminder that if you would like to chat to Dylan and his team after listening to this conversation, head to equitymates.com/advice. There's a form there to fill in and we will connect you. Off the back of last episode, Dylan, we did a little bit of a discussion around debt recycling and you've been absolutely hammered with requests from the community, which is great from the community with who are wanting to know more. So that's what we're going to do today.
Yeah, it's awesome. Phone has been off the hook. On the back of that, we talked about maybe giving people a little bit of a case study to answer some questions, going a little bit deeper, but also talking about it, like you said, like with other scenarios. Like there's not only one way of building wealth, like we know, and everyone has different preferences, but this is one that is pretty fun. It's pretty attractive to a lot of people. So yeah.
Now we're going to get a little bit practical in today's episode. There's going to be some numbers flying around. Dylan kindly has built an accompanying document for this episode. So if you go to the link in the show notes or in the YouTube description, or if you go to our Facebook discussion group, you can find the document and you can read along as we talk through it.
Dylan has also put an extremely strong disclaimer on that document to encourage people not to do it by themselves. And if they are, looking to do any of these strategies, please speak to an advisor.
Yes.
Yeah, 100%. And don't read the document if you're listening to this podcast while you're driving as well. So with all the disclaimers out of the way, should we get into it?
Yeah, let's do it. So Mr. Equity and Mrs. Mate, we are in that accumulator phase, Dylan, which is a bit of a buzzword thrown around. Can you help us define what accumulator is?
So an accumulator is someone who, as the buzzword suggests, is accumulating wealth. So we call that the income earning time or income earning part of your life, where you are working for an income and you're accumulating, you're putting money away, you're building wealth in your maybe house or equities or whatever it might be. This stage of your life is where your income is growing and your assets should also be growing. So you're accumulating wealth.
Yeah.
Love it.
And it's really, it's defined by, I guess, like a life stage, as you just explained. But like, is an accumulator then anyone from 25 to 60, or are we?
Yeah, well, I mean, if that's when you decide to start retirement or decumulation, so when you just start to want to live off your assets, but that could be 50 if you want to get there.
Yeah.
What we call retirement is when you choose to stop working and draw an income, when you start decumulating your wealth or assets. Not necessarily that your assets actually go down at that point, but it's where you draw down on them.
Nice. Well, we are certainly in that position right now, Mr. Equity and Mrs. Mate. Our risk profile after chatting with you, Dylan, is 100% growth.
Yeah. Do you guys have kids or?
No kids.
No kids. No.
We're dinks, double income, no kids. Our employment income, we both earn $200K a year, pretty healthy.
Yeah.
And we have an annual surplus after all costs of about $30,000 a year or $2,500 a month. Which I actually think is pretty low.
That's what I was about to say.
Very low.
Like,
if you're both taking out, if you have accumulated $400,000 a year and you only have surplus
what?
of
So
30,
$400,000 after tax is it what, like $300,000?
It's a bit less than that.
less.
Yeah.
It's about
And your-
270, 280.
If your after tax income as a couple with no kids is $280 and you're only saving $30,000,
$30,000, yeah.
look
Yeah.
at your expenses.
Well, I mean, principal and interest on your mortgage is probably going to be $80,000.
okay.
So that's that. If you've got no kids, so probably in this scenario, Mr. Equity and Mrs. Mate do have one or two kids, and perhaps they're going to private schools.
The cost
of-
of
cost-
Sure,
yeah.
sure,
Okay. Well, you're
okay.
changing the scenario.
You got to tell us all this stuff.
It's in the disclaimer. You guys should have read
Nice,
it.
nice. Anyway, we'll keep getting through it. Current assets, we have our primary place of residence at 1.5 million val, and cash on hand of 250,000 sitting in an offset account.
Yeah, that primary place of residence is a 2-bedroom unit in the Blue Mountains,
Nice.
Based on Sydney prices.
Yes. Liabilities on that, we have a mortgage on the place of $1 million over 25 years at an interest of 4.75 with annual repayments of just under $70,000.
So a couple of disclaimers or a couple of notes on here. So people have probably heard 4.75 as the interest rate. Interest rates are obviously a lot higher than that at the moment, but because we're modelling over 25 years, the expectation is not that interest rates will stay at where they are. It's that they will be in an average of somewhere between 3.5% and 5% during that journey. We're probably estimating overs, but we like to, I guess, showcase a scenario where it's going to be more expensive to do this than less.
Interesting.
It's interesting that you think you're estimating overs there, but that's probably a separate conversation to what we're doing now.
We can talk about that.
Now, Dylan, at the top of this episode, we mentioned that we're going to use this scenario to answer a number of common questions we get. And so I think the starting point will be talk to us about the overall scenarios that could be relevant to us. And then as we go through each one, we can sort of unpack them in more detail for people who are unfamiliar with some of the terms. But let's start high level.
Okay, so 3 scenarios that we often get asked about. One is offset accounts versus investing. And we won't necessarily explicitly answer that question, but we will in the broader 3 strategies. So how to use your offset account to pay off debt in an effective way when you've got surplus cash flow. So effectively just paying down your mortgage faster. The second one that we get asked a lot, and it's something we actually been asked a lot by people in their sort of late 20s and even sort of throughout their 30s, is whether or not they should be making additional contributions to super using their surplus cash flow. And the answer is probably yes, but it depends on what else you've got going on. And as we'll see when we get to the end, no spoilers, but superannuation is an incredibly tax-effective way and good high growth asset to be saving into throughout your income earning years. So that's one strategy that we'll also explore. And the third one, which is probably the one that we get more questions than any from the Equity Mates community and from our other client sources and client base, is just saving on tax and the way in which we can invest and save on tax at the same time. And that's debt recycling, which we mentioned in the last episode. And yeah, it's a great strategy. It's something that I think can help a lot of people with large mortgages not end up with a lot of debt at retirement.
So 3 scenarios. Which one do you want to start with?
The easiest one to start with is probably keeping money in your offset. And there's not a lot to be said about that other than the fact that paying off your home is a wonderful goal. You can do that using, effectively a tax-free rate of whatever your interest rate is. So in our scenarios, they've been, interest rate of 4.75%. It's effectively what you're earning, no tax on that, and you're paying down your mortgage at a much faster rate by doing that. I caveat that with the fact that this scenario has come out the worst of the 3 over that 25-year period, in that if you continue to use your offset beyond paying off your mortgage, you're not earning any interest other than what the bank's willing to give you on a normal savings account, which at the moment is, say, 4.5% to 5%, but generally speaking has been closer to CPI or slightly below CPI. So we're talking between 1% and 2%. So with that, it's wonderful to get your house paid off. But my question to people that want to do that as fast as possible is, what are you going to do with the money that you then don't have to use towards a mortgage?
What if you'd modelled it rather than keeping that money in what is essentially a high interest savings account? What if they had then invested that money in the stock market?
Well, you could certainly pay down the mortgage and then start to invest from that point onwards. But what happens in that, whilst we haven't done that for the purpose of this example, is that you start your compounding journey 15 years or so behind where you would have otherwise. Yeah. And as we'll see in the numbers, and as we can see with any compound interest calculator, years 20 to 25, you probably make 5 times as much money as years 1 to 5, maybe even more than that. Yeah. And that's probably where I think the issue with that strategy comes. It's you've waited to take on the market risk and therefore you're not rewarded by long-term compounding. Yeah.
I think I can remember this off the top of my head. I did this recently. $100 a week invested at 10% a year over 30 years gets you like 900K, a bit over 900K. If you extend those out years from 30 to 40, it goes to like 2.3 million.
Yeah, wow.
So you extend the timeline 33% and you increase the return. You increase your total assets by like 170%.
That's
like
incredible.
those out years in the ones that matter in compounding.
Yeah. That's why we look at all of these strategies as long-term strategies. Like, you don't invest for 5 years expecting that you're going to have this huge sum of money at the end. You know, the adage of get rich slow, which we love and I know you guys do as well, it makes sense. And the reason is because once you've taken the time and you've done your work, you get rewarded significantly just through market forces. Capital, right?
So Dylan, just to put a bow around scenario 1 for now, it's just putting that surplus cash that they had into the offset account and everything else as is. Superannuation just keeps ticking away. They make no additional investments outside and away they go.
Yeah, absolutely. And look, as we'll see at the end, again, no spoilers, you still have a very healthy balance in super, very healthy balance in cash, plenty of money at the 25-year point. Let's say that.
Yeah, nice.
Yes. We will go through scenario by scenario at the end with the actual numbers, but we won't throw a whole bunch of numbers in now. Yep. So let's go to scenario 2, which is the contributing more to superannuation.
Yeah. So in these lovely people, Mr. Equity and Mrs. Mates scenario, their employment income is $200,000 a year. They're getting 11.5%, so $22,750 or $23,000 a year in superannuation guarantee from their employer. And then on top of that, they have the ability to make an additional $7,500 of concessional contributions to super. So that's additional contributions that you can claim a tax deduction on when you make them, reducing your before tax income, but not reducing your after tax income by as much. So for anyone that's unaware, superannuation contributions, provided that you earn less than $250,000, are taxed at 15%. And for Mr. Equity and Mrs. Mate, their top marginal tax bracket is 47%, including the Medicare levy. So there's a big upfront tax saving, which you get some of in your personal name by getting some of that money back that you would have put away as investment savings. But also your superannuation is actually growing by the difference of 32 cents on the dollar for every dollar you put in. And that's the kicker there. So you don't feel 100% of the putting the money away up front, but your superannuation is what's growing.
Yeah. So in scenario 1, they paid off their mortgage and they put their excess cash in their offset account to pay off their mortgage
in order
quicker.
To pay off the mortgage, yeah.
In scenario 2, they paid off the minimum amount on their mortgage and the excess they were putting in their superannuation, trying to max out that concessional contribution.
So here, the maximum amount that they can put into super as their surplus was $7,500 each, and then the remainder we've assumed has gone into helping pay down the debt.
I'm still noticing a serious lack of stock market investing here, Dylan.
Well, that's the scenario. I challenge that though, because your super is stock market investment.
That is fair.
And so when we're comparing the next strategy, which is outside of super investments, we have assumed the same underlying investment. So for everybody's purpose, assume that it's a Vanguard high growth fund, right? Or beta shares, or you pick your provider. But the underlying investment here, regardless of whether we're comparing superannuation or outside investment, is the same on a returns basis. The only difference is the tax treatment.
Nice. Now let's turn to scenario 3. And this will have a little bit more explaining. So this is the debt recycling strategy.
Yes.
Now, before we get into how Mr. Equity and Mrs. Mate are going through it, just give us a debt recycling refresher.
So debt recycling is the process of turning non-tax deductible debt, usually from your principal place of residence or equity in your principal place of residence, into tax deductible debt. And you do that through a process of paying down or drawing out new debt against your principal place of residence, and then investing that into income-producing assets. Because that debt has been used for an investment purpose, similar to going and using debt on an investment property, and it's income-producing, you are able to claim the costs associated with that investment, and interest is one of those costs. So effectively what you're doing, and what these lovely people here in our scenario are doing, is taking their savings that they have at the bank. They're actually paying down $250,000 of their mortgage, and then they're going to take out a new loan for $250,000. They're then going to invest that, and the income that's generated from that investment, plus what they can regularly save, is going to pay off their mortgage each year and then be redrawn as new tax-deductible debt.
Easy.
Sure.
Makes sense. And in that scenario, the total repayment on the loan doesn't change?
That's right. So if you think about it, before and after, your interest rate remains the same and your amount of debt actually remains exactly the same. So if you guys have $1 million of debt beforehand and $250,000 in the bank, if you pay down $250,000 of debt and then take out new debt of $250,000, you've got $1 million of debt, exactly the same as what you had before. So that's where I think a lot of people stumble at the start. They go, I'm going to take out new debt. The reality is here, you're not taking out new debt. What you're doing is you're changing the purpose of the debt that you already have using assets or equity.
Yeah.
Now, just to make that really clear, you have $250,000 cash in the bank and $1 million of debt, and then you use that $250,000 to pay off the mortgage and then redraw it. And so you've got $1 million of debt still and $250,000 in cash still. But the reason that you do it, for people who are wondering why you don't just invest that original cash in the stock market, is all of a sudden that $250,000 of redrawn mortgage debt, the interest you pay is now tax deductible rather than it not being before.
That's right.
That is just government policy. For some reason, property investors get their mortgage debt tax deductible, whereas people just trying to buy their home to live in don't get it tax deductible. That is a policy conversation, which we don't have time for today, but that is just the reality of the situation.
You don't get tax deducted debt, but you don't pay capital gains on the asset.
Yeah, that is true. That is true. Yeah.
So,
win-win.
Swings
I
and
know
roundabouts.
you guys talked about that a couple of weeks ago.
But importantly, if you debt recycle your primary place of residence, you get the interest rate you get the interest payments tax deductible, and you still get the capital gains exemption.
That's right.
Yeah.
So again, we probably don't want to go too far into how the policies and tax law works, but effectively, yes, the asset that you live in is still capital gains free.
Yeah.
The asset that you invest in is not capital gains free. So that's what that debt's being used for, and that's why, because you're paying tax on it, you're paying tax on the income, you're able to then claim the cost of generating that income.
Yeah.
We now, as Ren said, we have $250,000 of tax deductible debt that is now invested into the stock market. We said it earlier that it's at our risk profile is 100% growth, so we're going to be investing according to that risk profile. What are you suggesting happens with the additional $30,000 that these Mr. Equity and Mrs. Mate have? Is that also put into the stock market?
That's right. So each year, that $30,000 that is in surplus is put into the stock market. Now, whatever goes into the market plus whatever earnings. So if we assume that the investment made 10%, 5% was income, 5% was capital growth, we'd take the income portion of 5% plus the regular savings of 30,000. We'd take that out. We'd pay off additional debt at the end of the year, non-deductible debt, and then we would redraw new deductible debt. And so by reinvesting that money throughout the year, you're obviously compounding your investment through regular contributions and also the investment return, but you're changing the profile of your debt faster.
In that instance, would it be best to be have the underlying investment actually to be spitting out as much income as possible?
Yes and no. I mean, theoretically, you could do that and create, significant amounts of income-producing investments. You're going to be taxed in that year. So it depends on how that income's being generated. Is it being generated from fully franked shares, or is it being generated from other, fixed interest style, high yield investments? So the answer is we don't know.
True.
We actually look at it on the basis of if you had zero income coming from the investments and you had enough surplus to do the recycling in an efficient manner, you would have more control over when you sell down your shares later. And if you sold them when you weren't earning in retirement, say, you could reduce your capital gains by doing that. But that again is it's a rabbit hole.
This is, I mean, I think what we're pulling out is this is why it's like it's so dependent on your individual circumstances, the salary you're making, like what other tax deductions you have, all of that stuff, and which is why personal advice matters when we get so specific. I am also fast realising why Australian investors love franking credits so much, though, to your earlier conversation. It's not just retirees that can get paid some of their franking credits back in cash. It's also like accumulators doing these tax strategies, and you start to see the power of it. So that is a separate conversation. Dylan, you've included some charts, and I think if there's one thing that we've learned over years of podcasting, it's not great audio to try and explain charts on a podcast.
If you're watching video, we'll flash them up though on YouTube. We'll flash them on YouTube.
So watch the YouTube version of this episode, everyone who's listening.
Or I think this is probably a good place to just remind people that there is an accompanying pack that goes with this episode that is available through the show notes and on our Facebook discussion group or the YouTube description. So if you want to see the charts that we're not going to explain that really illustrate how Mr. and Mrs. Mr. Equity and Mrs. Mates can think about debt recycling, head over to the accompanying packs.
Two key things that probably the takeouts of the charts, and we won't go into them, is in the debt recycling scenario, you pay off your non-deductible debt in this situation by about year 13 and a half. So your mortgage is paid off. At that point, you could sell down your entire investment portfolio and have no mortgage.
Wow.
Assuming the investment portfolio hasn't tanked, but that's a separate conversation.
Again, steady, all projections are wrong, not long into the future. But of course, in this example, assuming it hasn't tanked at that point. The other point, which is really good to make, is the difference between total non-deductible interest that you pay during that time versus the total deductible interest in debt recycling, and then overall the difference in interest that you pay in total. So over that 14-year period, whilst you're paying off the house, you actually have $356,000 of tax deductible interest paid. So that's $356,000 over that 14 years that you can claim as a tax deduction. Not every year.
No. And I think the important thing to stress there is that $346,000 in interest or whatever, like the majority of that you would have been paying anyway. It's just you wouldn't have been able to claim the tax deduction.
That's right. Yeah. So the non-deductible portion, if you do debt recycling, is $242. And if you don't do debt recycling, the total interest payable is $689,000 over that time period.
Yeah.
And the total interest payable with debt recycling is $599. So it's $90,000 of interest that you don't pay.
So Dylan, just to clarify for my own understanding, we said earlier that you're just flicking your mortgage from non-deductible debt to deductible debt and the interest rate stays the same. But you just said there that there's like a $90,000 difference over the life of the loan in the interest you actually paid. So can you just explain that?
Well, that's because you're claiming a portion of that interest as a tax deduction. So each year, the before debt recycling and after debt recycling has a tax benefit, and you accumulate that, basically paying off the mortgage and paying less tax as a result.
All right. Well, look, people can look at the chart pack that we spoke about. Dylan's got a specific chart in there that talks to that. But I think this is probably a good place to just pause, take a break, digest these numbers, and then on the other side of the break, we're going to get to the heart of this conversation, what I'm sure everyone has been waiting for, which is the comparison of the three scenarios, how Mr. Equity and Mrs. Mates are going to look at the end of 25 years under each of these scenarios. So stay with us. We'll be right back. Welcome back to Equity Mates. We are here for another Ask an Advisor episode. Mr. Mates and Mrs. Equity, I think I got that the wrong way around. Mr. Equity and Mrs. Mates walked into a financial advisor's office and
Said,
wanted...
ouch.
Out your feet.
and wanted to know how they could best set themselves up for their future. Dylan is our financial advisor today. He gave us 3 scenarios. Put as much money in your offset account as possible and get that mortgage paid off as quickly as possible there. Max out your superannuation contributions, take advantage of the only free kick in Australian finance, which is your superannuation tax advantaged account. Or the third strategy was debt recycling. Dylan, before the break, you walked us through the 3 strategies. You explained the concept of debt recycling for people who are less familiar. But this is what we've been waiting for. This is why we pay the big bucks for our statement of advice and our ongoing advice. It's how do we get our best outcomes? So take us through scenario by scenario. How are we going to look after 25 years? How much are we paying in tax? What does our net wealth look like? What is the optimal strategy for Mr. Equity and Mrs. Mates?
So drum roll, please. Look, unsurprisingly, scenario 1, which is to put money into your offset and saving cash, is the worst of the 3. That's not to say that it's a bad strategy. I think the number that we've got here is about $7.1 million in total assets in 25 years from now. So that's accumulating property wealth, superannuation, and then you've got a whole bunch of money in cash, which of course you could invest in the later half of that journey.
Now, just to talk to some of the numbers and the assumptions, if people aren't reading along, the property value is the same in each scenario.
That's correct.
And so that stays the same. In this instance, we've just done our minimum superannuation contributions required by law. And then the third big bucket of assets we have is the additional cash we've accumulated after paying off our mortgage early. And it works out to be $7.1 million. So look, like that doesn't sound bad. That sounds pretty good for a lot of people.
Well, I think that's a bit over $4 million in liquid assets come retirement. So I think, look, for a lot of people in their 30s, early 40s who have this about timeline, and a lot of the anxiety that exists for accumulators these days is that this strategy is the easiest possible thing that you could do, and you will be absolutely fine.
When I saw that, I did think that you wouldn't be in a position where you'd be forced to sell down property to liquidate.
No. I mean, inflation would have to be considerably out of control by that point to make our lives uncomfortable, assuming we had $4.4 million in assets at that point.
Yeah.
That's a pretty comfortable sort of $250,000 drawdown with very low risk.
Yes. Yeah.
I'm also just doing the maths in my head. You said our property value is $1.5 million.
Yes.
In all 3 scenarios, you've assumed it's $2.7 million 25 years later.
Yep.
There's an old adage that property doubles every 10 years, which in a recent episode of the podcast, we actually kind of disproved in some ways, but you've said over 25 years it doubles. So like it's quite conservative, I would say.
It's very conservative. And look, when we're using an asset that is the same across all 3 profiles, particularly with property, we can't assume that everyone's got waterfront or someone might be living in the middle of nowhere, bush. So we just use CPI for property.
Yeah,
so it's 2.5% year on year. it compounds effectively over 25 years, almost doubles. Chances are it will be more than that, but it's not an investment asset that you want to be using in retirement if you can avoid it.
Yeah.
So it's the same across all three. We could up or down it, I guess.
So at the end of the day, 7.1 million in assets spread across property, cash and super. Scenario number 2, as a reminder, was to go all in on super. We said we were going to be doing maxing out our concessional.
Max out your concessional, the tax advantage, and then anything incremental above that.
Just go for it.
Still put it in super, even though it's an after-tax contribution.
Yeah.
Because once it's in the super environment, there's still a tax advantage once it's in there.
Exactly. Yeah. So you're earning. Your earnings on that investment are taxed at a lower rate than what they would be if they were in your personal name.
Yeah.
So where we end with that is a whopping superannuation balance of $6.7 million.
As opposed to 2.6 in the first scenario.
Yes. No cash in the bank as opposed to the 1.8, and property remains as it is. So your total assets at this for this scenario is 9.4 million. So almost an additional 2.5 million by going all in on superannuation.
This strategy actually comes out as the best of all three strategies. And we talk to a lot of clients about the fact that superannuation is such a amazing free kick, like you said, in terms of the fact that the earnings are concessionally taxed for the lifetime of that investment. And then once you get there, provided that there's been some inflation adjusted on the superannuation laws around having a $3 million balance, your tax on the income from those investments is going to be largely, if not all, tax-free.
Yeah.
And so that strategy, even if you still had debt at that point, and we use this strategy a lot for people in their sort of 50s, where we actually start to supercharge those super contributions using previous years, using as much non-concessional as well as we possibly can, because it's an effective way of building up wealth in a tax-effective environment. And then we pull the money out when they get to 60 or 62 or 65, whenever they choose to. They can pull that money out, zero tax, and wipe the remaining balance of their debt.
Handy.
So as you said, you kind of gave away this third scenario, but we'll stick on scenario 2 for a second. But this is actually the best performing of the three in terms of like the total assets that you walk away with at the end of 25 years.
It is.
So the question becomes, what's the downside of scenario 2?
It's liquidity. So if you think about putting money into super, and the reason why we don't want to do it, the reason why at the end of the year when we have the choice of putting that extra $5,000 or $10,000 into super and we choose not to, even though the math stacks up, it's because we can't get that money for 20 or 30 years. And although there's a good benefit later to us, and there's a small sometimes a considerable tax benefit, that tax benefit ends up in your superannuation. And so it's a difficult thing to say, hey, for the next 25 years of your life, just put all your surplus cash flow into your super and just live like this. Because if an emergency happens, or you change your mind, or you decide that, you know, something significant in your life changes, you know, maybe you two have another third child, you might want some of that money, and you might need a significant amount of that to go and do something that you care about. So everything in moderation is a much better way of looking at these strategies. I think there's a combination in there somewhere of all three that probably suits everyone. But the reason why, albeit the slightly best but only slightly better scenario, we don't necessarily suggest that 100% of your surplus should go into super.
Well, that's a good point to go to scenario 3, because it is only slightly better when you look at it compared to debt recycling.
It's about 109,000. Almost to the dollar.
Yes.
So $109,000 at age 25 years from now, whatever timeline that might be. $109,000 over $9.273 million
Yes.
is a relatively small price to pay for liquidity on approximately half of your portfolio.
So that's the total asset value you would have if you did debt recycling, 9.27 million. That's made up of baseline superannuation, no additional contributions of 2.6 million. The big difference here is that you've now got an investment portfolio of just shy of $4 million that you've been working at over that debt recycling over 25 years, and your property is 2.7. So there's that $4 million in liquid assets that's spitting out an income as well.
Absolutely. And this is the point in life where, we're assuming that in all three of these scenarios, you're retiring, you're no longer wanting to work once you've paid off your home. And each of these assets are going to provide an income stream for you in retirement. So having the ability, perhaps in scenario 3, to do that 5 years earlier, where superannuation you might not have access to be able to draw down that money. Could be retiring at 55 or retiring even earlier than 55 if you feel comfortable with the amount of assets that you've got.
One thing that we often speak about, we're speaking about it here, we spoke about it in the last scenario, is the benefit of retiring earlier, like having the liquidity outside of super allows you to retire earlier. Another thing that I don't think we speak about much, I'm interested if it makes a big difference, is the ability to draw on your super later. Let it compound in a tax-advantaged environment, not just until you're 62 or 65, but until you're 75 because you're drawing down other assets first. Like, does that make a big difference when you model it out?
It does. What would actually happen in these scenarios is probably in the 10 years leading up to retirement, or if someone wants to retire early, maybe slightly sooner than that, is we would actually be taking chunks of that portfolio out and then moving it from personal investment into super. And probably as the portfolio builds, we'd be making concessional contributions throughout. So, for anyone who's reading this is sort of like the level one of these strategies. And like I said before, the combination of these three is what gives you probably the ideal optimum outcome. But you're right. I mean, superannuation's not something that we get to 60 and just pull out. And it stays invested. It continues to be invested. And actually, the more money you have in there at that point, particularly if you've retired, you can start an account-based pension. There's 0% tax on earnings at that point. Like, we think super's a free kick. Pensions are a free kick. Pensions are a free kick from the goal square.
Yeah, right.
Definitely at that stage, on a pure assets basis, you'd be drawing down from your investments before you draw down from super.
With scenario 2, the superannuation one as well, that assumes that it takes the full 25 years to pay off the house?
That's right. Yeah. So in all scenarios, you're effectively paying off that $1 million of debt over 25 years. It's just that the tax deductible portion lasts longer as a debt recycling strategy. Your non-tax deductible debt's paid off in the 14 years.
Yeah.
So now that's
a lot to think about.
Yeah. Well,
sorry, everyone.
That's not even the big reveal, because that's just where your net wealth comes out at the end. And superannuation, we said 9.4 mil. The debt recycling strategy, 9.3 mil. The cash savings strategy is 7.1 mil. But the really surprising finding in all of this, Dylan, well, surprising for Bryce and I, probably less surprising for you, is of the three scenarios, the one where you pay the most tax is the tax focused strategy, debt recycling.
Like, what the hell?
So talk to us about the tax scenarios for all three and how it becomes that debt recycling, you're actually paying the most tax.
So the one you pay the least tax in is superannuation. That should be relatively straightforward.
Yeah.
The one you pay the second amount most tax is scenario 1. So cash savings, you're earning an interest rate on some of that money, but most of it's just income tax that you're paying. The reason that you pay more with the debt recycling strategy is because your investment assets get so large that you're earning such a significant income that you're actually being taxed at higher rates on that income, beyond the point where you're able to claim the tax deduction on it. So particularly over the last, say, 5 to 7 years, your investment assets are going to be probably in the millions and your debt's going to be in the few hundred thousands. So the cost of that debt, whilst it's still tax deductible, is not, I guess it's not as much of a benefit against the income of the investment. So there is a chart in the pack that will show you how the tax total tax paid goes over time. So have a look at that. It explains it visually very well. The way I like to look at this is your total tax paid over 25 years, and this might make people feel a little bit sick. If you just pay off your house, your total tax paid on those incomes is $5.64 million. That's a lot of tax.
It's so much.
It's so much tax. In the debt recycling strategy, you pay 5.78, but you end up with $2.1 million more in assets.
Yeah.
So you pay $120,000 more tax.
Yeah.
And you've got $2 million.
Yeah. I just did both of these, total tax paid over 25 years as a percentage of your total assets at the end. And for the debt recycling scenario, you pay the most tax as a raw number, but it's 62% of your total assets. And then for the cash savings one, it's 78% of your total assets. So like that's the different way to look at it.
Absolutely.
Yeah.
I mean, you know, as I said, most of that tax is on income, and you're going to pay that in every scenario regardless. The only way you can reduce that is by super contributions, and that's why we see there's a slight benefit there.
So everyone thought this episode would be about debt recycling, but the surprise twist at the end of the episode is that the scenario where you pay the least tax and you end up with the most money is maxing out your superannuation.
Still not going to do it.
I actually think so. There's a hybrid of these strategies where you use the concessional contribution.
Yeah, that's what I was thinking. You just
and then take the other part of your surplus.
Yeah.
So call it 15 into super, 15 into debt recycling, and you probably extend your loan by another couple of years by doing that, maybe 2-3 years. So it might be 17 years rather than 14. But you're also getting the lower tax. Now, again, vanilla, level 1.
Yeah.
That feels like the nice middle ground.
Yeah.
Well, that's it. And everyone's middle ground's different, right? So this strategy I'd be very surprised if this reflects an exact person, but it's a good indicator of where I think that some people sit.
We haven't even spoken about education bonds yet, but let's leave that.
I think
as a cliffhanger.
Let's leave that and say, you know, Dylan said this is level 1. Yeah. If you want to go to level 2, if you want to level up.
Level 10.
That level 10 is education bonds. That's a separate conversation. If you want to level up, if you want to speak to Dylan, if you want him to put your personal financial circumstances into his models and figure out what is right for you, head to equitymates.com/advice and we will put you in touch with him or his team, and you can have a conversation, a no-cost, obligation-free initial conversation with Dylan and the team and figure out if it's right for you. But Dylan, a massive thank you for joining us today on Equity Mates and for doing all this work for us.
We've never had, we should try and get more guests to do this more often. It's very comprehensive.
It didn't take any time at all, I promise.
and we will share it in the group as another reminder, so make sure you come across to our Facebook discussion group. Yeah. Love it. Well, thanks, Dylan.
No worries, guys. Good to see you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.